valuation is the ultimate KPI.
Hey there, welcome to the Valuations Podcast, brought to you by Truelytics, the premier business intelligence platform for the wealth management industry. My name is Mike Langford, and I'll be your host, and this is episode 6. And joining me today on the show is James Hughes from Live Oak Bank. And James works in their investment advisor division, specializing in the financing of deals between acquiring wealth management firms or individual advisors and those who are selling their wealth management business or their individual book of business. So you're going to want to tune into this one because it's really, really exciting. We're going to be covering the elements of financing because, who knew, by the way, that people don't just show up going, I like what I see. Let me pull out my checkbook and write you a check. Do you take a personal check? Right? That's not the way it works, right? There's legitimate financing involved, and there are places like Live Oak Bank that's specializing in helping facilitate those deals. So we'll talk a little bit about financing. How long does it take? What's the process? What do deal structures typically look like? We'll also have my favorite part of this episode is James and I go back and forth a little bit. Wouldn't call it a debate, but back and forth on whether it's a seller's market or a buyer's market. And what does that mean? Who's in the driver's seat when it comes time to execute a deal, right? And does that even matter, by the way, right? So really, really good stuff. Very interesting. As always, if you have feedback for this episode or things you'd like to see us cover on future episodes, hit us up at valuations@truelytics.com via the emails there. Or if you want to hit us up on social, LinkedIn, Twitter, Facebook, we're very active there. Let me see, where else? Oh, you can swing over to the Truelytics website, contact us form, right? Spend a little time poking around. You'll enjoy the site. Lots of good blog posts on the blog section, by the way. All right, let's do it. Grab your beverage, get your earbuds, sit back, and we're getting into it. Episode 6 of the Valuations Podcast starts now. Hey, James, thank you very much for joining me today on the show. I'm really excited to have you. It's the second time in a week and a half or so we've been across the screens together, hearing each other's voices without ever actually having met each other in person. So thanks for joining me.
Yeah, absolutely, Mike. Thank you for having me. And hopefully we'll meet in person sometime soon.
That's exactly right. It's always strange when you do that, right? When you've been talking to somebody on the phone or in our case over the VoIP, and then you finally meet the person in person, and you're like, "Hey, you don't look like your voice."
I feel like people always assume I'm older than I am, so maybe that'll be the surprise for you.
Is that what it is? Yeah, it's funny. It's funny you mentioned that. I listened to another podcast. I'm a big basketball fan, and it was one of the podcasts that I listened to. There's a guy on there, Chris Vernon, and he sounds like he must be a 65-year-old man, right? Just a grizzled veteran. And they showed a photo of him not too long ago. And this guy, he's like young. He's like 39 years old, and he looks young, and he's small, like a shorter stature guy. And nobody, he does not match his voice at all. So as long as it's not that dramatic, it'll be great.
Well, hopefully I don't disappoint when we meet each other.
Well, hey, listen, I like to kick these podcast episodes off first by kind of introducing you a little bit. And I know I've kind of welcomed you to the show here, but so first of all, you're from Live Oak Bank. And what was really interesting, I'm here in Austin, Texas, and anytime I hear Live Oak, I mean, there's so many businesses here named Live Oak in Austin because of the amount of live oak trees.
Right.
So I thought maybe you could tell us a little bit about Live Oak Bank and your role at the company so that people kind of get a little bit of a mental picture of who you are and who you work for.
Yeah, absolutely. So Live Oak Bank is a really unique story. We tell people that we're a small business and, we're here to service small businesses. So Live Oak Bank was started in 2008 out of our CEO's garage. Him and I believe it was 5 other partners got together and wrote the bank charter for Live Oak Bank. And really the idea, these are all sort of career bankers, spent their lives lending money to businesses, and they decided that they wanted to lend to veterinarians. So that's sort of how it got started. Wanted to only lend to veterinarians, and they wanted to really, understand the industry. The reason they chose veterinarians is because They have one of the lowest default rates and one of the lowest prepayment rates. And just to get an idea of sort of, the thought process behind these guys, they went out and hired 2 veterinarians to be on staff to understand the industry that in depth so that they could better serve their customers. And banking in general, when you look at the banking model, it's really every bank wants to be sort of an inch deep and a mile wide. They want to lend to every business, any opportunity that they can get. And we sort of flipped that on its head and said, we want to lend only into industries that we understand. So we started with veterinarians, and we sort of built out that model across. Now it's 20 different industries that we focus on. And through the evolution of Live Oak Bank, started 2008, we went public in 2015, and now we have over 650 employees, and we're really rocking and rolling. Then you asked me about my role. So as you mentioned, James Hughes, we did a webinar not too long ago. I am with the investment advisory team here at Live Oak. So me and our team, we lend just to independent investment advisors. And Live Oak has been in that business since 2012. We hired Jason Carroll, who came from Charles Schwab. He was doing the lending to advisors at Charles Schwab. And so he really built out the team in 2012. And I have been at Live Oak for 5 years this October.
Well, that's exciting. This is really interesting because, there's been a lot of, fintech startups and a lot of innovation in the investment, in the financial services space and in the lending space over the last, several years. And it's really interesting to hear that the company was started, that Live Oak was started in 2008, either right before the financial crisis hit or right after, right? Or right after that.
Yeah, definitely a very unique time to start a bank. Yeah. And, it was a good time for us because our bank charter is written as a cash flow lender. Okay. Which, I don't know if you know anything about banking, but, a lot of banks have a loan to value requirement where you basically are lending against collateral, like commercial real estate or, real estate or equipment or something like that, where it's tangible, physical collateral that we could collect if you didn't pay us back. So another way that Live Oak is really unique in that we don't have a loan to value requirement. We lend against the cash flow of the business. And that has really been what has set us apart in all of the industries.
That's very interesting. So I've had some clients in the alternative lending space over the years, and I have been exposed to that. You see that in merchant cash advances and so forth, which are, and to some extent, they are cash flow providers of the last resort for many businesses, but they also look at cash flow as the means to decide whether or not to fund a deal. So that's really interesting. So I'm kind of interested in you. Like, how did you said you've been there for 5 years now. What brought you to Live Oak, and kind of where were you before? Were you in the RIA space, or is this something that you started at Live Oak and that's where your interest came from?
Yeah. So it's a great question. So I am from New Jersey, went to school at Bucknell in Pennsylvania, and moved to Manhattan after school. Got a job at Morgan Stanley and worked there for about 9 years. I was on the institutional side of the business, specifically in prime brokerage. But basically, our clients are hedge funds, or the prime brokerage clients are hedge funds. So I was in a very different world, different but similar in working with hedge funds versus, individual advisors or financial, the RIA world. And I found Live Oak because I got engaged to my wife, who's from North Carolina, and her sister actually happened to be working at Live Oak. And I came down and had a few interviews, and it's just a very unique place. And, Live Oak, our CEO is very involved in everyone's, sort of day to day. And it's just a very special place here in Wilmington, North Carolina. It's a small beach town and the work-life balance, the quality of life, the autonomy you have here at Live Oak to be able to really develop yourself as a professional, but develop your business really is really much different from my experience at Morgan Stanley. And after coming down and interviewing with them, we decided to move south and come down to North Carolina and work with Live Oak.
That's fantastic. Well, congratulations, by the way.
Thank you. I mean, I just, I can't say enough about, how happy I am to be, at Live Oak and in the role I'm in, contrasting where I was at with Morgan Stanley. And there's nothing, I enjoyed my time at Morgan Stanley. It's a great company, but I was dealing with hedge funds and really, sort of what we would call institutional clients. And to sort of change that. And now my clients are sort of individuals, just like me and you are. And I'll go out and meet these people and talk to them about their businesses. And, a lot of these are small family run businesses with, maybe, father, daughter, or, you learn about them and their family, and you get to go into their office. And there's just a lot more, I feel a lot more connected to my job, and I get a lot more satisfaction out of it.
Yeah, there is something really rewarding about, connecting at the human level, right? Sometimes when you're in a big company, particularly as you mentioned, when you're in an institutional role, sometimes you can feel like you're just a part of the machine. And there's an element of everybody involved in the situation is somewhat detached, other than they're thinking of their bonus, right?
Right. Yeah, absolutely.
So, it's really interesting. And during the webinar that we hosted, it was you, me, and Carla McCabe from Truelytics. During that time together, we covered a lot of ground.
Yeah.
And by the way, for anybody listening who wants to hear a recording of that webinar, we'll make sure that recording is up in the show notes for this episode of the Valuations podcast. That'll be over on the blog.truelytics.com. So check that out, and you'll be able to hear that webinar and kind of and see everything. But before we dig into some of the deeper topics and questions that we saw come out of that webinar, and some of the things I wanted to cover with you today, I thought it might be a really smart idea to kind of give listeners, and particularly those, because I think the people who are listening are interested in potentially acquiring or selling a business, and they might not be aware that financing is one of the options available to them, right? They might just think, hey, listen, I just have to have the cash on hand. So let's start with, how common is it for deals to be financed?
Yeah, it's a great question. Obviously, I'm only doing deals that are financed. So, 100% of the deals that I do are going to, have a bank financing component. But I really can only sort of give you some tidbits that I hear from other industry professionals. And, we work with, obviously Truelytics and other, valuation companies, but also brokers that sort of put together buyer and seller. I would say that of the deals that are being done today, the majority there's some bank financing component, or I should say some outside financing component. So, if we go back to before bank financing was very prevalent in the independent advisory space, most of the deals were getting done with cash and then an earnout. And now that bank financing is more prevalent, that's really sort of going away. That model is sort of dying, and less deals are being done that way. And more deals are being done with an upfront cash component, which is typically financed, and then some back end portion, usually seller financing. So, it's definitely hard to put a number on it, because when deals are being done with just seller financing, they're not really being reported. So it's hard to get good data, but I rely on, the other partners we have in the industry. And I would say that the majority, if I had to put a number on it, I'd say 60% of the deals being done have a bank financing component.
Okay, very interesting. You're right. I don't think it is, for most of my experience in seeing deals, you're right. It was that, here's some sort of cash up front, and then you see the earn out. And that makes sense, right? That, look, I'm going to give you some money, but what I'm actually buying is relationships and a stream of cash flow that's derived from those relationships. So if those relationships don't stay because you leave, I've given you a whole bunch of money and everything goes to pot, right?
Right.
So it absolutely makes sense that there's some sort of, ongoing engagement, and then the remainder of the payments made out. But it sounds like what's really happening is the financing is getting involved to secure that deal, which also makes sense because I'm sure deals are getting more expensive. So speaking of,
so I just want to, you bring up a really good point there. I just want to say two things on that, right? So if a buyer comes to me and is saying, oh, hey, I'm talking to this, the seller, and we're going back and forth, and I'm not sure how it's going to work out, and I might be able to get this done as an earnout. From a buyer's perspective, an earnout is a great deal. If you did 100% earnout, there's no risk to the buyer, right? So the buyer's taking on zero risk, but the seller is taking on 100% of the risk. And because we have seen the acquisition market for independent investment advisors really not necessarily shift, but really become a seller's market where sellers are dictating the terms, that's why those deal structures are also going away, is because the seller is tired of holding all the risk. So it's really shifted to the buyer having to come up with some sort of larger down payment so that the seller is de-risking themselves on the front of the transaction.
That makes sense. So on your side, what are you seeing from a size perspective for these deals that you finance? Are they all big 7-figure deals, or are you seeing small deals as well?
Yeah, I wish they were all large 7-figure deals. We will do loans anywhere from $150,000 up to about $8 million. And that's really our portion of it.
Okay.
So we would do, a $20 million deal if the down payment was $8 million. So I would say that the average loan that we do is right around $1 million.
Wow. Okay. That's a good size, right?
Yeah, definitely. But we do smaller deals. And I think that one of the reasons we do smaller deals is because a lot of times, the younger advisor who might have, 20 million assets under management or 50 million looking to buy another 20 is somebody that we want to partner with. Really, our goal my goal in my job is to partner with all of these independent advisors and grow with them. We want to be able to help them grow their business inorganically through acquisition and help them do that through debt. But that's why we like to do the smaller deals, so that we can do the first deal and then the second deal and the third deal until really they sort of outgrow us as a lender.
So thinking about that, what's the general process for securing financing and getting a deal done? I don't think it's as quick as a fill out this quick form and tomorrow you have your financing, right? So what's the process there? If I was an advisor and I'm like, hey, look, I'm going to go buy this book of business over here. Looks like I might be able to get this deal done for $1 million for the acquisition price. I'm going to need to borrow $500,000. What's that process look like on your end?
Yeah. So the process, if you're at the stage where you just mentioned, where you sort of already have a purchase price, you're already progressing with the seller, is typically 2 months. So from the completion of the application to funding takes 2 months. Now, I would say that we are very consultative in our jobs. One of the founding principles of Live Oak Bank is that our salespeople are not commission-based, which is very unique as well in the banking world. Most lenders that work for banks are commission-based. And we've changed that so that all of the lenders have equity in the company, and therefore we're not motivated to do larger deals that may not be quality. We want to do just quality loans to protect our balance sheet and protect the health of our organization.
That's really interesting. You hit on something that I had thought of, but I like it. And frankly, it's one of the things that RIAs will hold themselves out as, hey, look, our interests are aligned. I'm not being paid by a commission here. Like, I have a vested interest in your success. And it sounds like with Live Oak, you have a vested interest in the success of the deals you make. You're not just earning a commission, right? You are basically part owner in the company that's financing this deal. So you really want to make sure you're making a good deal.
Absolutely. And that was the point I was trying to make, is that we are very consultative in that we talk to people, years before they do a transaction. And then when people come to us with a deal, they might say, hey, James, I have this $1 million purchase. And when we get into it, we will help with the structuring of the deal to make it more advantageous, or try to make it as fair as possible for buyer and seller. So we will help not only finance the deal, but structure it so that we're putting our borrowers, the advisors, in the best possible position.
Well, and I'm sure that's when you get into these deals, because for many of the acquirers or the sellers, this is the first deal they've ever been involved in. And having professionals come in who have probably walked through hundreds of these deals, offering to help them with the structure, advise them on what the process should look like, that's got to be welcomed, I would imagine, in most cases.
Yeah, absolutely. And I think what people, sometimes forget is, acquisition has been a hot topic for, as long as I've been doing this. Everyone wants to acquire. There's, so many buyers out there. But you're right. A lot of people, are doing it for the first time and need a lot of guidance, and we're happy to provide that. The other thing is that a lot of these people are doubling the size of their business. So it is a huge undertaking to go from, let's say 100 clients to 200 clients. It's a really big decision. And so, working with somebody that understands how to structure these deals, understands how to build in protection for the buyer, at the same time, getting the seller what they want, so that you can ultimately win the deal. And we talk about, the helping advisors win the deal, right? So it is an extremely competitive acquisition market these days with, hundreds, or, the numbers are all sort of all over the place, 40 buyers for every one seller, or 50. It's really, there's a ton of buyers for every one seller. So working with somebody that can not only get you financing quickly, but can help educate you on how to structure deals and get the seller what they want, but also protect you as a buyer, is going to ultimately help you win the deal, which is the most important thing, right? So, people like to talk about interest rate or terms. At the end of the day, if you don't end up winning the deal, you don't end up being the buyer, then, all the rest of it is sort of a waste.
Right. So you mentioned something, you actually hit upon this, which is great. I'm really glad you brought it up in talking about what you see in the market there and deal structure. You mentioned that it's a seller's market. And I thought I really loved the conversation we had only briefly during the webinar we did together, and that you have a position that and it's based on your experience that it's a seller's market and the seller's driving things. And it's interesting here at Trulytics, we've kind of had the opposite feeling, that the buyer is in the driver's seat, right? That the buyer is controlling the deal, because at the end of the day, he or she is the one who decides whether to buy your firm or not. And of course, the seller can decide, I want to back out as well. But you had some a really interesting perspective on it. And I thought it would be fun to explore that a bit here, of like, why do you see it as a seller's market? What is it that makes it a seller's market in your mind?
Yeah. So I think that there are scenarios where the buyer is, controlling or has some of the cards, right? So we've seen deals where the seller is checked out of the business. So maybe they're only working 3 days a week. They're golfing. When they come into the office, they're not really, servicing clients. They're not really managing the day to day. And maybe they have an equity owner in the business, a junior that already has some ownership in the business, and they're the succession plan. So in that case, the seller's hands are a little bit tied, right, on valuation, on purchase price, on structure, because if the seller doesn't agree to sell to the buyer, then the risk is really that the buyer says, all right, fine, I'm walking away altogether. I'm going to go open up a shop next door, and I've been servicing these clients for the past 5-10 years. They're all just going to come over to me without any sort of compensation being paid to you. So in that scenario, yeah, I agree that the buyer really is holding the cards more so than in most scenarios. Really, when we talk about it being a seller's market, is the open market of acquisitions within the independent investment advisor world, where, if a seller is truly selling to an outside party, and, whether that's within their broker dealer or outside their broker dealer or from broker dealer to RIA, if they're really sort of holding up their business, I have $100 million in assets under management, 100% recurring revenue, all set up as fee-based accounts, and they're just looking for the highest bidder. If they're going to take in bids from multiple buyers, and the seller's basically going to dictate what they want, in terms of down payment and valuation. And if a buyer doesn't, put together a good offer, then the seller is simply going to go on to the next buyer. And, we see that a lot with, the brokers that put together deals. Not that they're driving up the price, but just that they're bringing multiple buyers to the seller. So the seller can really, like we've said, dictate the terms, which typically means them taking more risk off the table on day one, which means, a larger down payment, and, which is really the opposite of where the acquisition market has been historically.
That's interesting. So what do you think a seller should do to ensure that they get the best deal for their business? I mean, assuming like, hey, look, I'm ready to sell. I'm 65 years old. I am that guy who's like, I'm kind of am checking out. I'm golfing a lot, and maybe it's time I exit the business, and I think you can get something. What should they be doing to make sure that they get themselves in a position to get the best deal for the business?
Yeah, that is a loaded question. I feel like the most important thing, you would think from a seller standpoint is making sure that their clients are taken care of, right? So finding the right buyer for the business should be the number one concern. As we talked about, earlier, these are small businesses and local communities for the most part, and these people have built their businesses with, all their clients are friends and family, people in the neighborhood. So they want to be able to go to the country club or go to the supermarket and be able to, look at their ex-clients in the face and be proud of who they sort of pass the business on to. So that would be the first thing I would say is who you're selling to is probably the most important thing, so that, your clients ultimately get taken care of. Now, in terms of maximizing the value of your business, the things that we see maximizing value is going to be the net income of the business. So having a very strong bottom line, or EBITDA, or net income, that's going to be the biggest driver for value. And the other thing is recurring revenue. The more of your revenue that is based off of fee-based accounts or recurring revenue, that's going to drive the valuation multiples on your business.
So speaking of valuation, I would like to get your take on the importance of valuation. You mentioned Truelytics is often involved, or you're using services like Truelytics as part of the process. So I assume, like, before you finance a deal, you require some sort of independent valuation to be done on the seller's business before you proceed with funding the acquisition. Kind of much in the same way that a mortgage lender requires the appraisal for a house, right, before they lend the money to buy a house. What are you looking for in that valuation?
Yeah, we're looking for the valuation to support the purchase price. And we require a valuation for any deal, any purchase that's above $250,000. Anything below $250,000, we'll do our own internal valuation. Anything above that, we really want to have a valuation company that specializes in the industry do a valuation to make sure that our buyer is, again, protecting themselves and not overpaying for a book. And what we look for in the valuation is, we'll go through and sort of look at how the book is structured, the average age, revenue per client, the revenue per assets, that sort of thing, to really understand the book that they're buying.
So what are some red flags, I guess, that a firm should be sure that they take care of before they begin the process of exploring a sale or an acquisition? Are there things that you say, hey, look, if this is happening in your business, make sure you fix it before you think of selling? Or if you're a buyer, if you see this thing, you might want to back away or potentially just abandon. Like, what are some of those red flags that you've come across over the years?
As a seller, if you are somebody that is still, mainly upfront commissions or really, like just trails. I mean, that's something that if you're looking to maximize the value for your business, you really kind of want to move to fee-based accounts. I mean, that's where you're going to get the highest multiple on your business. So, I mean, red flag, I don't know if it would be a red flag, but, we continue to see that the industry is moving towards the, fee-based accounts and away from, commissions, and specifically upfront commissions. As a buyer, okay, it is, when you get into a conversation with a seller and all they're really talking about is valuation and how to maximize what they're getting from you, that also, I think, is a red flag. The first conversations that buyer and seller should be having are around, philosophy, conversation like we're having today, just sort of get to know you, talk about the business, talk about, your methodology around servicing, around investment management, and, get to know each other. It's really sort of a matchmaking effort. And the deals that we see go really well are the ones where buyer and seller are a great match. And so if you're in a conversation and, all the seller is talking about is, this is how much I want, that might not be, a good situation to get into.
Yes, I love that. Because, actually the most recent podcast episode we did, we was talking to a gentleman by the name of Jim DiCarlo. He's the CEO at Strat Wealth, and he was talking about that very notion of, hey, look, culture matters, right? The relationships you have with your employees, your advisors, trickle down to the relationships you have with your clients. And of course, it's the clients that matter at the end of the day. So I love the fact that you're talking about philosophy matters. The way you approach doing business matters, because you've got to have a match there. Otherwise, it's going to be a shaky business after the close, right?
Absolutely.
So, one other question I have for you, and it's just while we're on the topic of valuation, but what are your thoughts on a firm having a valuation performed, even if they aren't considering a sale or an acquisition anytime soon? You think that's valuable to their business?
Yes, definitely. Having a valuation done on your business not only gives you an idea of sort of what your business is worth, but also it gives you an idea of how you are building value within your book. So you can take a look at the valuation and say, just like I was mentioning earlier, the upfront commission business is not really, giving me that value. So although, it is nice to do that business, that's not really the future of my business. I should be really focusing on converting customers to fee-based accounts, because that's really going to increase the value of my business. And we talked about this on the webinar, but I've gone in and used the Truelytics tool. And one thing I really like about it, or your valuation, is that you assign grades and you can really sort of dig into the valuation and look what part of your business can be improved. So maybe you've got a C in some component of your business, and you can go in and, make that a goal for this year to really improve that from a C to a B. And it's sort of like a report card that you get at the end of the year, and you can see how you're doing.
Right. It's interesting about those grades too. The thing that jumps out to me when I look at the Truelytics scorecard is realizing that those scores are coming from comps, right? That you're looking at other businesses that look similar to yours in terms of size and structure, and you're being graded partially based on that, right? So if you are a seller or a potential acquirer, other people in the market are going to be able to compare you to that business. And if I was thinking about buying your business, I'm going to compare you to what else I can buy, right? That's a similar asset size. So if I look at you and I want to bring in a certain amount of cash flow and a certain amount of AUM, and I find out that your business is weak compared to others, just like anything else in the world, right? If you're buying a house and you look at one house and then another house right across the street is selling for a little less money and it's in better shape, you might not buy the other one. So as we're getting ready to kind of wrap it up here, I don't want to keep you too long, but looking out to the future, it was one of my favorite parts of the podcast is just kind of asking people, like, put your crystal ball out there and think about where the world is headed. What can advisors expect for the future in terms of, deals? Are we going to see more deals coming? Are the sizes going to increase or decrease? Our deal structures changing and so forth. You already mentioned one change, going away from the earnout and shifting the risk to the buyer versus the seller. What are the things you think might change in the future, and whether it's near future or the next decade or so?
If I had a crystal ball, I would give you all the information. I think we thought that with DOL coming out, there would be a lot of advisors that sold. And I don't know that we saw, the large uptick that we thought we were going to see there. And, maybe people just thought it wasn't going to happen. And, obviously that worked out. But we go to, many events throughout the year, and everybody's always talking about the average age of the advisors increasing. So just based on that alone, you would think that, deals would continue to come in, and even more deals would continue to happen. I think that for the foreseeable future, there will be a consistent flow of books that will be sold. And the only thing that I can think of is sort of what a lot of other people are saying, is that the folks that do it well and put together good, strong teams, good workflows, good processes in place, and have proven that they can be a place for people to sell to, that will continue to see consolidation within the industry where, certain firms are continuing to acquire.
Makes sense. Very good. I really enjoyed having you on the show today. So before I let you go, I'm sure people are going to have some questions. You're going to have some people who want to follow up with you and touch base. I'm sure there'll be people who are looking to sell their business or acquire a business. What's the best way for people to find you?
Yeah, absolutely. You can email me at james.hughes@liveoak.bank, or you can give me a call at 910-550-2295.
Very good. And I assume you guys are on social media as well. You're on LinkedIn or other social media?
Absolutely. Yep. I'm on LinkedIn. I do not Twitter, but we do have a handle for Live Oak that we try to keep updated, but LinkedIn would be the best way to get me.
Perfect. Well, thank you once again, James. I loved having you on the show. And again, you'll be able to hear this episode, obviously, and on the show notes, people will be able to also hear and see the webinar that we recorded together as well. So if they want to get a little more deep dive information that way. Thanks again, James, and hope you have a great day. Hey there. Thank you for spending some time with us today on the Valuations Podcast. It really does mean a lot. And it's not one of those false, kind of half-hearted, hey, thanks a lot for coming type of deals. I really do mean it. Thank you so much for spending time with us, because this show is for you, and we spend a lot of time and effort on it. We have a great vision for what this will eventually evolve into, and we are in the early stages of it. And the fact that you're here for episode 6, and hopefully the 5 episodes that came before this, really means a lot, because you're part of our early stage community, and we are growing this thing. I do have one favor for you. Please do subscribe to the show. So head over to iTunes, Stitcher, SoundCloud, wherever you like to listen to your podcast. Find the Valuations Podcast and subscribe to it there. Help us build awareness, right? And subscribers actually count. They help people discover the show. Like our posts about the show on social media, on Twitter, Facebook, LinkedIn. And then, of course, don't be afraid to share this with people at your company or people that you network with, right, in the industry, because they can get value out of the Valuations Podcast as well. And lastly, I want to hear from you. I'm really interested to hear your thoughts, feedback, and no critique is off limits. So if there's something we're doing that's annoying, or something you'd like to hear more of, or something we haven't even thought of covering yet, please do send in those suggestions. You can reach us via email, valuations@truelytics.com, or you can reach us on the socials, right? LinkedIn, Twitter, and Facebook. And lastly, of course, you can always swing by truelytics.com and poke around, which you should be doing anyways. Spend some time over the blog, by the way. There's some really good blog posts over there, really informative stuff. And then, of course, you can hit us up on the Contact Us page there. Okay. Hopefully you enjoyed this episode. I look forward to chatting with you next week. I think we're going to have a gentleman by the name of Jeremy Carnell joining us for the next episode of the show. I've been trying to wrangle him for a few weeks. He's been hard to get. So hopefully we get him on the show. All right. We'll talk to you next time. Have a good one. See ya. Bye.